The biggest mistake I see when it comes to investing is that people do not diversify enough. They get excited by one type or one even specific investment, and it means that their portfolio becomes super concentrated, super dependent on that one thing. And unfortunately, if that one thing goes badly, then so does their entire investing outlook. So I decided it was about high time I made a video on what diversification actually is, why it matters and how it works, and also how you can introduce it into your investing in a really, really simple way. So here we go. Let's take a look. My name's Zoe and this is my channel, Words on Wealth. Welcome back. Hi, it's great to have you here. Hopefully you are enjoying these videos. Do make sure that you like and subscribe if you are, because it really helps me to understand what's working well. And also give me any comments of future videos that you would like to see as well. So let's dig into diversification, which is what today's video is all about. So all the diversification means is essentially having a big mix of different assets, geographical regions, sectors, things in your investing portfolio. Because the broader spread that you have when it comes to investments, generally, the more likely they are to ride out any relevant ups and downs in the different areas. Because there's one thing that we do know when it comes to investing, and that is that there will be ups and downs. I can almost promise you it. Nothing will ever just go directly up. I know it'd be fabulous if it did, but that is not how investing works. But thinking about those ups and downs, we can put steps in place to try and avoid them being too bad and to try and mitigate the impact on our overall portfolio as well. The way that we do that is through diversification. Now, as I mentioned, diversification can mean lots of different things because in reality, investing can mean lots of different things. Investing generally means that you're putting money into something that you expect to grow or generate an income. Now, usually what we're talking about is the likes of stocks and bonds because they're some of the simplest places to get going as a beginner investor. But you might also have other things in your portfolio too. For example, you might have commodities such as gold or silver. You might have property, real estate. That could be in physical form, you know that you own a building, or it could well be through the likes of property funds. You might also have things like crypto or even foreign currencies as well, throwing in further layers to the overall mix of your portfolio. Now, the key reason why diversification is so important is that because generally we see that different classes, different groups or different categories of investments move in different ways at different times. And in an ideal world, you'd have lots of different groups that were all moving in different ways at different times. So if you imagine if one's going up, then the other one will be coming down and vice versa. Now, there is an official way to understand some of this relationship between the going up and the going down, and it's known as asset correlation. This is essentially a calculation that's carried out, and you don't need to worry about it, but rather just understand what's going on behind the scenes. And this calculation shows whether assets are correlated perfectly or not at all. Now, if assets are positively correlated, what we generally expect is that they both move in the same direction at the same time. So if one's going up, so will the other one. An example of this might well be, for example, US and European equities. So stocks in the US and stocks in Europe. Usually what we've seen over time is that when US stock markets are going up, so are European ones. But they're not perfectly correlated. It's not like as soon as the US market moves, so does the European one. If nothing, of course, is perfect. But usually the patterns suggest that they are more or less on the same wavelength. Now, negative correlation would mean that the assets move in different directions. So when one is going up, the other is generally going down and vice versa. Now, an example of this would be within stocks and bonds historically. What we've seen over time is that usually when the stock markets are going up, the government bond markets are going down. As a result, they're not superbly popular in times of stock market booms. However, usually when the stock market is in a slower period, also known as a bear market, we usually see that the bond market, the government bond market, comes through. Now, not all assets are correlated. Some might have what we just call low correlation, and this would essentially mean that we can't really see any patterns in the way they behave or interact with each other, because nothing is aligned in that way or shape or form. Now, in an ideal world, you would have a bunch of different assets, regions, sectors that had some level of negative correlation in your portfolio. Because if you think back to that, what that would mean is that while some were going up, others were coming down. If you only had positively correlated assets in your portfolio, that would mean in good times things would look pretty brilliant, but it would mean that in bad times things could look pretty terrible because everything is going to be going in the same direction all at once. So a balanced portfolio would ideally have some of those different asset classes in there, because normally these are the ones that are most commonly associated with a negative correlation when it comes to their interaction. So I'm talking about the likes of stocks, sometimes known as equities as a group, and bonds, as well as other things such as commodities like gold and silver. Normally what we see is that, as I say, these main groups that I've just mentioned move in different directions. We've seen some slightly funny times recently, which hasn't meant that this is always the case. But when we look back over historical data, usually they interact in different directions. It's worth noting as well that most people will still have some cash, or at least some liquid assets that they're able to access pretty quickly. In fact, it's almost imperative before getting going investing. Depending on what your risk profile is, will depend on what percentage of different asset classes you pick. It'll also depend on what your overall goal is. For example, if you're looking for high levels of growth but you're not bothered about income, then you may lean more towards higher risk, higher growth stocks, rather than if you're someone that is, for example, already at your goal, be it retirement or otherwise, you may well have the likes of more bonds in your portfolio because they generate a more steady income and are generally associated with lower levels of risk. You can build a diversified portfolio relatively simply with just a blend of different ETFs, funds, or indeed even individual assets, depending on what kind of portfolio you are building. Lots of beginner investors and indeed long-term investors start with the likes of ETFs and index funds because they're super simple to follow, easy to understand, and relatively low cost. But as always, do what works best for you. If you were, in this example, looking to build a diversified portfolio of different ETFs, you may well introduce ones that are following, for example, major developed nations. You might introduce one that's also following emerging markets. On top of that, you might put something else that's following a different asset class, such as bonds or indeed an ETC, which is then tracking some sort of commodity. ETC just stands for Exchange Traded Commodity instead of Exchange Traded Fund. Diversification is more important than ever this year. Here we see on this chart lots of different colours and lots of different moving numbers, but it's a really useful illustration of why diversification is absolutely key. It takes us back over the last 10 years, and of course, slap bang in the middle of that in 2020, we've got the impact of the global pandemic. This is acutely seen within these figures. We see that a lot of the time, those US stock markets come out on top. And actually, what we see in 2025 is that the European equities are the ones that have so far come out on top, closely followed by those Asia-Pacific ones, and then emerging market. US stock markets are actually quite a long way down that pecking order. We see that, as I say, in previous years, US equities come out pretty strong, be it 2024, 23, 21, 29. I could go on, you get the idea. Whilst emerging markets, which are those ones in red that really stick out, really boom and bust. They shot up in 2016, 2017, and all the way back down again. They came back up again and back down again, and we can literally follow it like a pattern throughout those years. They are known as a volatile asset class, which is why they're not suitable in everyone's portfolio, because they go boom and bust quite rapidly. If, for example, you're somebody that has a higher risk tolerance, you may well seek to add more of these. But if you're someone that has a lower one, they just might not be quite right for you. Now, if we also take a look within that at the likes of bonds, we've got the grey for corporate bonds and the green for government bonds too. You can quite clearly see how often when in 2016 we see corporate bonds and government bonds are somewhere there hovering around in the middle and US equities are at the top. Now, if we fast forward 2 years, we actually see corporate and government bonds at the top of the table, whilst US equities then fall in next. And that's the exact example of what I was saying when we're talking about those negatively correlated assets, whereby normally when one is doing well, the other is doing quite badly, and vice versa. You see this pan out as well if you look across the rest of the chart into future years. Apart from, as I say, this year, where things have started to change and look a little bit strange. But more on that in another video. So here's 3 steps that you can take to build your diversified portfolio. Step 1, it's all about setting your goal. This is key to picking any investments. And it's why when people say to me, what is the best investment? What should I have? How diversified should I be? But what percentage should I have of this one? And my answer is always, I don't know, because that depends on you, your circumstances, and what your financial goal is. Now, the reason is because if your financial goal is a long way away, so 20, 30 years away, it may well be that you're able to take more risk. If your goal is a little bit closer, it might well be that you can afford to take a bit less risk. There's also other circumstances in the mix, things like how much of your overall wealth does an investing portfolio represent? What is your personal attitude to risk? Is it high or is it low? It's all very well and good me telling you all this, but if you're going to have sleepless nights, there is no point going ahead with that investment. So first step is always set your goal, and that helps us to then start to put into place the So first step is always to set your goal, and then that helps us to filter down into what investments are going to be best suited to you. Step 2 is all about thinking about building your core mix. Now, normally what people do with their portfolio is that they focus on building a solid core. This is often constructed with the likes of ETFs because they're low maintenance, but it can be done with any funds or any other investments, depending on your level of experience and what you want. Now, within that core mix, ideally, you'd have a blend of negatively correlated assets that we've spoken about today, as well as ones in different sectors, different geographical regions, and so on. A nice blend. Usually what I say is that if you are looking at ETFs, for example, having 5 as a minimum in different areas, because if you've got 5 in the same area, it's not going to count, obviously. They need to then be in different spots to be able to start building that core. And then step 3 is all about adjusting and rebalancing. This is where we're focusing more on thinking about that longer term view, having a look at what's going on within those colourful charts that we've seen today, understanding how things are performing over time, and adjusting for changes like what we've seen in recent years, whereby bonds, gold, silver haven't quite moved quite so negatively with the likes of US equities. It's about tweaking and understanding and playing along with whatever the world throws at us. So there we have it. That is 101 of why diversification is so key to your portfolio and how to avoid it, whether you're a beginner or indeed a long-term and relatively seasoned investor. Throwing in those different assets, merging them all so that the correlation levels are different is what is hopefully going to get you and your investment portfolio through the good times and the bad times as well. Thank you so much for watching this video. I do hope you're enjoying them. As I said at the beginning, do make sure that you like and subscribe, and leave me a comment as well if you enjoyed this afterwards, if you want more tips on your diversification levels within your portfolio too, and any other videos you'd like to see in future. Bye for now.